Hey everyone, this is GreenSpy Trades. In this video, I'm going to show you how you can apply day trading techniques to help predict when a correction in the broader stock market is about to happen. These ideas are based on observations I made on volume and price action in historical instances, and represent my own personal ideas on patterns that could occur during switches from bull to bearish market cycles. The first early indicator of a correction that I'd like to talk about is a change in character of the price action in the S&P 500. So a typical bull market has small daily price movements that on most days drift a little bit more into new upwards territory. Retracements from these recent highs are by a small percentage, and most of the time they form lows that are a higher price point than the previous retracement low. The market can usually continue in this pattern for several months, and the longer it goes on, the more likely it is that a correction is going to occur sometime in the near future. So one of the ways that this stable bull market trend can change is by stalling out and failing to move to higher price points for some period of time. Here's an example from 2015. The S&P 500 hit a point of resistance just above the 2100 area and failed to move through it despite several rallies. My guess on the reason that you see this kind of change in price is that professional money managers with a better grasp on fundamentals and macroeconomics might be selling their stock at the highs and moving to cash. And so you see the symptom of the bull market itself just reaching a point of exhaustion. Here are a few more examples of stalling price action. One example of a change in character of price action that was very interesting to me is the beginning of 2018. After a strong bull market of 2017, 2018 opened with an acceleration of upside momentum in the month of January before crashing suddenly. Essentially, the S&P 500 made a parabolic price action move, which is very unusual for an index. Now, a second early indicator of an impending correction which I like to look out for is something which I call a breakdown day. In many cases, significant stock market corrections are immediately preceded by a breakdown day. So going back to our view of the 2015 stock market correction, the intraday price action of August 20 was significant. All day the price action was very weak and steadily pushed downward throughout the day. It ended the day testing recent lows on the daily chart, with downward momentum building into the close. It also stayed solidly below the 200-day moving average, which is a strong indicator of a change in trend. I think this is the kind of price action that causes optimistic long-term holdouts to reconsider their positions overnight and place orders to liquidate long positions the following morning. So as you can see, on August 21st, the market gapped down, and then from there began a turbulent time for the stock market. You can also see distinct breakdown days preceding the February 2018 correction and October 2018 correction. And the third factor which I think increases the likelihood of a correction is the time of the year. Late August through October seem vulnerable to corrections more so than other times of the year, and this is just my personal observation. The 1929 crash happened in October. The 1987 stock crash also happened in October. And Lehman Brothers went bankrupt in October of 2008. And that set off a chain reaction causing the Great Recession. It might have something to do with locking in gains for the end of the year in the fourth quarter. Professional money managers who are compensated based on portfolio returns might be locking in gains by selling their stock and thereby protecting their year-end bonuses. Also, individuals with investment accounts might be doing a little bit of selling in advance of the Christmas season expenditures. I've also noticed that specific calendar dates such as the rolling over of a quarter or calendar month seems to matter. The big correction at the end of 2018 began right at the beginning of October and bottomed on Christmas Eve. This makes sense as people might be inclined to make changes in their holdings to better manage their performance around set events such as earnings seasons or holidays. So is the stock market at risk of a correction right now as of October 2019? Let's have a look at how things stand in the market right now and whether it's giving a sign of an impending correction. Once the 2016 election was over, The S&P 500 entered a steady uptrending bull market for just over a year, and then in 2018 we started to see some wild swings. 2018 ended with a significant 20% drop from the all-time high. If it could be attributed to a particular news catalyst, I'd say that would be the rising interest rates and rhetoric from the Fed. The market started to recover when Chairman Powell changed his tone about the Fed's commitment to interest rate hikes. It was about then when the yield curve also began inverting, signaling that the bond market is anticipating a lower federal funds rate in the near future. 2019 has proven to be a choppier market, with larger retracements from the all-time highs as you would get in a smooth bull market. I think this could count as a change in character of the price action. However, after each rally, it has continued the trend of making a higher low with each retracement. If you wanted to get short the S&P 500, starting a position at the top of the range is a good strategy because you would be anticipating a retracement to the bottom of the trading range. Now let's look at the intraday price action. The October 1st chart is very interesting. Like the other days where we have red candles, volume is strong, and on the 5-minute and 15-minute charts, price steadily and consistently pushes lower and lower. Also note on the 5-minute chart the red line indicating the previous close. The day started up green for the previous day, but then reversed into being down for the day, which is a fairly bearish intraday sort of move. If you were anticipating a correction to begin, October 1st could be the kind of breakdown day I talked about earlier. An important observation I made from studying the S&P 500 is that the kind of price action that you get after 3 p.m. and into the close could tell you a lot about the direction of the stock market and where it's headed over the next several days. If volume picks up and the close is strong, that's an indication of a multi-day bull market trend. But if selling volume accelerates into the close, that's a multi-day bearish signal. So the idea that October 1st could be a breakdown day gets confirmed on October 2nd, which is another down day for the market. Now going on to Thursday, October 3rd, it looked as if the bearish action would continue. At 10 a.m., the market started to decline very rapidly on strong volume. If you had a bearish stance, it's very tempting to chase something like this. However, I found through experience that a few scary looking red candles in the early morning trading can be traps. This type of selling can stop as quickly as it began, and the market will recover. The way to not fall for this is to keep a handle on where the longer time frame charts are at. On the 15-minute chart, or the 1-hour chart, this doesn't look nearly as dramatic. Also, always consider where you are on the daily chart. This move is bringing the market right to an area of support, the 200-day moving average, as well as giving it a chance to form a higher low from the previous pullback. As you could see later in the day, that shakeout of the market marked a short-term bottom that makes it a mere blip on the long-term chart. The lesson here is, don't get too wrapped up in 1-minute or 5-minute charts if you're trying to catch a big picture move. Now let's go on to the October 7th chart. This intraday action gives you some clues of a short-term reversal. The market dances around the level of the previous day's close, which I like to call the red to green line. Note how in the afternoon the SPY hits an area in the 295, but it can't push through, and then it sells off on strong volume going into the close. In the following days, the market pulls back to the bottom of its short-term range. So as of Friday, October 11, the most recent day of trading, we have another day that looks like a reversal, even though it's solidly gapped up from the previous close. At this point, I think it's very hard to tell where the market will go from here, and as a technical trader, and knowing my own style of trading, the best option for me is just to wait and see for a more predictable pattern to develop. Either the bull market will calm down, the price ranges will tighten up, and it will trend up like a normal bull market, or this pattern of higher lows will break and there will be a correction in the stock market in the ballpark of about a 10% retracement or more. Well, that's all I have to say for today. I hope this video gives you some new perspectives on how to read intraday price and volume to make a better short-term directional bet on how the overall stock market will perform. If you did find this to be helpful, be sure to hit the like button and subscribe to this channel for further updates. See you on the next video.